Let's bring in our market panel, New Street Advisor, CEO, and CNBC contributor Delano Saporu, iCapital's chief investment strategist Anastasia Amoroso, and EY Parthenon's chief economist Gregory Daco. Welcome to you all. And boy, it has been choppy, Anastasia. I wonder how you're trying to pull a message out of what the market has been doing here. Just a few weeks ago, we were worried about runaway bond yields to the upside. The Fed was going to have to get so more hawkish. The economy might be overheating. It's completely turned around. 10-year yield at a 6-month low, and we're worried about the economy suffering from a credit crunch as we price in some Fed rate cuts. So where does it leave you as an investor at this point?
Sure, Mike. Well, there has been so many reversals in the last few weeks and just really in the last 24 hours. And it's interesting because first, the market reaction to what I call a de facto Fed pause, if not the end of the hiking cycle, it was a positive one, but then it got derailed by, statements from Janet Yellen around deposits. But when we came in again, and the markets once again this morning, the markets once again focused on the fact that the Fed is nearing its terminal rate of 5.1%. So I think that's the most important message. And this outperformance that we've seen in the NASDAQ and the tech trade, I suspect can actually continue, because if we're in fact done with rate hikes, that's a positive for valuations. And if we do see a slowdown further in the economy due to the credit tightening in banks, that means that it's back to the growth trade. It's back to where you can actually find reliable growth, and it's tech. So I think the moves of the market so far in March have actually been the correct ones, given what's going on.
Right. So maybe there's a bit of logic to it. Greg, I'd love your thoughts on whether, in fact, we can kind of navigate this economic landscape right here without really tipping over into something a little bit scarier. In fact, on that score, we do have some comments today from Gary Cohn, a former NEC director, about the prospects for a soft landing.
Now that the Fed has lost control, it is more difficult. When the Fed was in control of slowing down the economy by raising rates and just making it more expensive, I felt like we could maneuver a soft landing. Now that we're just taking money out of the system and we're really taking loan availability away, it's not loan availability at any cost, it's just loan availability is gone. I think the ability to soft land gets more difficult.
Greg, do you buy that? Do you think that the economy has more resilience to it than that?
I think the economy is undeniably slowing. We are in an environment where we had already seen some slowdown in terms of economic momentum, whether it's business investment, employment growth, or even consumer spending. They're all slowing. There's no massive retrenchment, but the current conditions where we're seeing tighter credit conditions and tighter financial conditions are undeniably going to weigh on economic activity. The one thing I am concerned about is this disconnect, massive disconnect right now between markets pricing as many as 4 rate cuts before the end of this year and the Fed saying that it does not anticipate any rate cuts. It's going to have to readjust either to the upside or to the downside. And I think to some extent that points to the lack of a firm anchoring of Fed policy in the current environment. Excessive data dependence is a very risky position in this type of extremely volatile macro environment.
Well, I mean, to that point, Greg, I mean, we have the 2-year note yield around 3.84. It's a full percentage point below where the Fed funds rate is. I mean, historically, when you've had that kind of upside down setup, it usually has meant tough things for the economy. It usually has meant that the Fed was likely headed for easing, no matter what they've said about it, because I don't suppose they're ever really going to preview their intention to do a 180 and switch from hiking to easing, are they?
No, they're not going to preview any form of easing right now, because they are still very much concerned about the inflation environment being too hot and the labor market being too tight. That was the message that we received from Powell yesterday. In noting that there may be some additional tightening, very dovish words that were used, the Fed Chair Powell also insisted that he did not foresee any rate cuts. But I think that dissociation between the current state of Fed policy and its intent with regards to inflation, with regards to the labor market, and what markets are pricing is a massive disconnect that will end up in some significant repricing, either to the upside if markets essentially believe that the Fed will maintain rates at a higher level, or to the downside if the Fed eventually ends up cutting rates. But I think to some extent we'll find room in the middle, and there will be some repricing that's necessary in the current environment.
Delano, if we're basically destined to tip into recession in the coming months, it will have been anticipated for well over a year, right? I mean, the markets have been kind of living with this prospect for a while right now, and arguably did a lot of work to price in some measure of it, right? The S&P went down 27%. The S&P's gone nowhere in 2 years. You've actually seen some of the economically sensitive groups start to fall away in recent months. So where does it leave you as an investor in trying to figure out whether, you know, the market is still vulnerable here to a worse economy, or if we can power through?
Yeah, Mike, it's tough for investors right now. You really have two sides of things, right? You have obviously the risk-free rates that have risen, and that looks attractive to some people that want to have cash safe and obviously ready to be available. And then you have investors that are looking at equities and looking at where yield is right now, right? So you have yield roughly at 5.85%. You're looking at yield that's not so much more attractive than the risk-free rate. Now, if you're looking at earnings, which have come down, earning estimations, which have come down, you can look at that. And if you're an investor, say, all right, there's two reasons why I'd be investing in equities and stocks right now. It's one, if I believe the revisions of earnings that have come down are a little bit too bearish, and earnings might end up being better based on what companies have been doing to right-size their costs and to fix their cost structuring, right? And so that would mean that yield would be a little bit higher and you get more for your dollar investing in the market right now. The other reason would be if you do believe there will be some sort of pivot coming sooner rather than later. Based on the most recent Fed statements, they've taken out some of the language that said that they may not pause or pivot. And so that might be a reason for investors. So those are the two reasons that hinge on if investors would find the equities market is attractive right now, because it is roughly two paths right now. It's disinflation and a weaker demand and really a pullback of equities, or we do have some sort of area where we pivot and the valuation for growth and a lot of other things look a lot better.